This video is about whether you can retire at the age of 65. I'm Simon, a certified financial coach, and I'm going to walk you through the details of finding the answer to this question. We are going to piggyback on the profile of Ben for this case study, who I covered in my previous video titled How to Use a Template to Create a 50-30-20 Budget. The content for this video includes Ben's profile, dive into each of the 5 steps to making the determination, and a summary. Let's begin. Ben is 35 years old, is single, has a job, rents an apartment, owns a car, and owns a dog. Your situation may be different than Ben's in age, family status, dependents, assets, or years until retirement. However, the approach that we will use to make a determination remains the same. We are going to use a 5-step approach to find if Ben can retire at 65. Step 1, calculate Ben's current expenses adjusted for 30 years of inflation. Step 2, calculate Ben's savings, accounting for 30 years of investment compounding. Step 3, calculate Ben's income in 30 years based on a withdrawal rate. Step 4, adjust Ben's income in 30 years based on additional considerations. And step 5, assess Ben's income versus expenses in 30 years dollars to make a retirement age determination. From Ben's budget that is available from the previous video, we extract Ben's annual expenses, income, and savings. His pre-tax income is $144,000, his expenses are $67,440, his annual savings at $2,400. And his current retirement savings balance is $150,000. In step 1, we will calculate Ben's current expenses adjusted for 30 years of inflation. We're going to use one of the future value calculators available online. We enter 30 for number of years, $67,440 for annual expenses. We enter 3% for assuming annual average inflation rate going forward, and 0 for periodic deposits. The calculations gives us a future value in 30 years of Ben's annual expenses of $163,695. To note, the historical 30-year inflation has been at 2.2%, and using a 3% number is a valid conservative approach. This completes step 1. In step 2, we will calculate Ben's savings, accounting for 30 years investment compounding. Using the same online calculator, we enter 30 for number of years, 150 for current savings, 10% for expected annual yield, and $2,400 for annual savings. The calculation gives us incredible value of savings in 30 years of $5,973,088. To note, the historical 30-year return of the S&P 500 index has been a bit over 10%, and using a 10% number is quite a reasonable assumption. However, if someone wants to assess the impact of more conservative assumptions, say 9 or 8%, they can try these numbers as well. This completes step number 2. In step 3, we will calculate Ben's income in 30 years based on a withdrawal rate. We are going to use a 4% number for income withdrawal. The 4% guidelines suggest that you can withdraw 4% of retirement savings annually without the risk of significantly depleting your funds and having an income stream that lasts for decades. A 4% withdrawal rate on a $5,973,088 amount is $238,924. This would be Ben's annual income. And this completes step number 3. In step 4, we adjust Ben's income in 30 years based on additional considerations. In previous steps, we assumed that Ben's income, expense, and savings levels will remain the same for 30 years, adjusted for inflation. In reality, a number of life events could happen. Ben's income could go up with experience, enabling him to earn more and save more. Ben could have a child or could need to take care of older parents, having to increase expenses and reducing his savings rate. Ben could also qualify for Social Security benefits, increasing his retirement income. Adjustments to the income in Step 3 are specific to circumstances of each individual and families, and it affects the need that needs to be considered. In Ben's case, we will assume that Ben is at the beginning of his career and his income will increase 2% over inflation, allowing him to save $5,000 more a year for 20 out of the 30 years. This extra income will allow Ben to save extra $286,375. And based on 4% withdrawal rate, will add $11,455 to annual income for a total of $250,379. And this completes Step 4. In Step 5, we assess Ben's income versus expenses in 30 years dollars to make a retirement age determination. In 30 years, Ben's annual expenses will be $163,695. These expenses will need to be covered with after-tax income. Depending on the type of savings, Ben's income could be taxed for long-term capital gains or as ordinary income. Considering a 30% tax, Ben's after-tax income will be $175,265, and it will be sufficient to cover his expenses. As such, great news for Ben. The determination is Ben can retire at 65. In summary, your situation may be different than Ben's in age, family status, dependence, income, expenses, and savings. However, the approach that we use remains the same for calculating and understanding if you can retire at the age of 65 or any other age. Use the calculator with different assumptions for inflation, yield, and withdrawals. Your savings, income, and expenses will determine possible retirement age. That's it. Feel free to drop any question in the comment section. If you find this session valuable, please like it and subscribe. Thank you for watching.